Okay, I think we'll start about now. People could be joining, but let's start on with the meeting. So, first of all, hello everyone. Thank you so much for joining this. And uh, today we'll be having a financial literacy session with two guest speakers, LK and Anirudh. And first off, a big thanks to the Sammamish Youth Board, the FLC team, and anyone who supported our committee. Um, Today we're going to give you some information about FLC, and we'll talk about the details of our committee. To start off, we're a local board that's aimed to provide resources to help and grow and maintain your financial health. We post weekly blogs, and we've started podcasts and events just like this one. We'll be interviewing numerous experienced individuals in the field and will share our findings with you. Our first goal is providing you with the resources to learn about finance so you can make informed decisions about your money. The reason we're doing this is to decrease the average loan that somebody has and homeless populations in our area. Now, to introduce our amazing board that has tirelessly worked to make this possible, Calvin, Misha, Jaden, Lahima, Parth, Nathaniel, Bashruth, and myself. Some of them were not able to make it, but all of them have put a lot of time and effort to make this possible. Now, let's introduce the Sammamish Youth Board president that's going to talk about SYB and what they do.
Anyways, as I was saying, so I'm a sophomore at Eastlake High School. I'm in 10th grade, and I am the chair of the Sammamish Youth Board, which, for those of you who aren't familiar with it, is basically a almost a commission in a way under the city of Sammamish. So we are a city of Sammamish entity. We're comprised completely of high school students, like Drew and myself. And what we generally do is a range of different activities, whether relating to the city council, or relating to things that have to do with city government, whether that's civic action, whether that's civic literacy, similar to financial literacy, where we're just trying to teach students more about how to engage with their city government. Or in a lot of cases, it's just things about improving our community as a whole, whether that's environmental, whether that's educational. There's so many different things we do. So this year, Drew went ahead and started the Financial Literacy Committee, which of course you guys just heard about. And this is just another one of the initiatives under the Sammamish Youth Board for educating people in our community and specifically focused on teens. So of course, if any of you guys want to learn more about the Sammamish Youth Board, or if any of you guys want to consider applying for the Sammamish Youth Board and making a difference in your community, just as Drew is doing here, whether you want to teach people about financial literacy, whether you want to work on any sort of other initiatives that target teens in Sammamish, feel free to check us out at the City of Sammamish website, or you can contact Drew or me if you want. I can, if it is there, yeah, there's a chat. I can put my email in there. Yeah, take it away, Drew.
Also, we'll be putting a few links, including the FLC website and some pages that could direct you to more information about anything. So if you guys have any questions, you could go and click on those links. And now we'll go ahead and start our session. And Anya, then LK, go ahead and take it away.
Thanks, Dhruv. Great introduction. Let me share my screen. All right. So, good evening, everyone. My name is Anirudh. I have with me my co-founder LK here. We both started a financial advisory and financial planning company called FinandMe Wealth Partners a couple of years ago. When Dhruv invited us to give a talk to the Financial Literacy Committee, we thought it's a fantastic opportunity because you're all at a very early stage in life, and if you're able to learn about the way money really works, you can make it work for you for the rest of your life. People who don't understand money end up working for money, but you're at a stage in life where you have all the time to really make money work for you. All right, so with an interesting title, Trap and Magic of Capitalism, we'll figure out what it is. We're going to start with a story. Um, so some of you might have heard of the story, maybe others haven't. This story has been retold many different ways in Europe and America, but because you guys are in the US, let's go with the version where there is an American and a Mexican, an American banker and a Mexican fisherman. So the story goes like this. There's an American tourist. He's a Harvard MBA, an investment banker. He goes on a vacation to a tiny Mexican village, and he just sees a Mexican fisherman just sitting by his boat and catching some fish. And he was very impressed with how soon the fisherman is able to catch the fish. And then he just goes, talks to him and says, how long does it take for you to catch, a bunch of fish every day? He says, not very long. And but then he finishes his catch, and then he just tries to leave. And then American asks, if you just stayed longer, you could catch more fish. But the Mexican says, oh, I've got enough. I have enough to feed myself and my family. I don't need more than that. And then the American asks, okay, but what do you do with the rest of your time? You caught fish, you went home, you had fish for food. What else are you going to do for the rest of the day? He says, I sleep late, I fish a little, I play with my children, take a siesta with my wife. In the evenings, I go to the village, see my friends, have a few drinks, play the guitar, sing a few lives, sing a few songs. I have a full life. And then, the Harvard brain starts kicking, and then he says, you know what? If you just fish longer every day, you can sell the extra fish you catch. And then with the extra money that you make, you can buy a bigger boat. And the Mexican asks, okay, all right, I get a bigger boat. Then what? So basically, the businessman talks about the various ways in which he can make more money, and then with more money, how much he can spend, what kind of things money can buy, and then finally, uh, when he asks, okay, what after that? What after that? And then finally, the Mexican says, you know what? Once you make all that money, you'll be able to retire, live in a tiny village, sleep late, play with your children, catch a few fish, take a siesta with your wife, spend your evenings drinking, and enjoy your friends. Essentially, this, it's like that's what this guy's been doing all along. So here are my four interpretations from this story. Right? There are probably aspects that you might not like, but essentially, the point is, regardless of what it is, American capitalism and one of the greatest countries in the world, it's about trading your value and trading your skills for money. Whether you are at McDonald's flipping burgers for minimum wage, or whether you are a investment banker, whether you are a um, um, technical developer, it's all about trading your value and skills for money, right? And once you make money, you can definitely buy a lot of materialistic things. The world is all about um, advertising and marketing and enticing you to buy bigger things, buy newer things, buy shinier things. There is enough things, and there is no depth to the kind of things that you can buy with money. And there are other things as well. Money can get you more money. Like this guy is talking about, you buy a bigger boat, and then with that money, you can invest more. That's where money works. And money eventually can buy you time. When you no longer have to work for money, you can buy time. Essentially, you don't have to work for anybody. You're not forced to work. You have the time to do whatever you want in life without having to worry about getting enough money for your paycheck, for your bills. Sorry. Um, so the first thing is, the, you need money to start with. Even if you want to make more money, even if you want to invest in, create passive income, you still need some money to start with, with your investments. There are a lot of people in the last 2 years who started getting interested in Robinhood and trading and crypto and all of that. All of those promise you quick money, easy money, uh, getting rich faster and all of that. But there is nothing that is more long-standing than having your own skills, especially as economies go through recessions and economic cycles. Uh, Skills and being able to trade those skills for money is what will be more long-lasting. So our advice is basically is that at this age, focus on developing your skills. Focus on getting good at things. Focus on. I know this is a financial literacy um, presentation, but none of these would make sense. None of these would apply if you don't know if you're not able to make money. If you go to college, you become a developer, you go to Google, obviously you'll be making so much more money than what you might be able to do with just trading or whatever. So the first lesson, the fundamentals of all of this is to be really skillful, become indispensable to the economy, become valuable, trade your value for money. That is the platform. You cannot build a foundation of money without that. You need to be useful for somebody who's willing to pay money for what you can do. um, and then once you make money, what kind of things do you need versus what do you want? There is no limit to what you might want to buy. You might be interested in brands, you might be interested in costlier things. um, but where do you draw the line? So here's an example. So Mike Tyson once had a net worth of $400 million, and you would think that that money would last more than enough lifetimes for 2 or 3 of generations. But he filed for bankruptcy at the age of 34 because he just went and spent everything that he had. He probably didn't have a good financial advisor. So it's possible for you to make a lot of money and still end up spending all of it because there's no debt to what you can spend. Um, you might want an iPhone, you might want a Ferrari, you might want branded shoes, whatever. I think Mike Tyson went above and he bought tigers and mansions and fancy carpets and whatever. Um, but the point here is you need to be careful with how you spend your money as well. You need to differentiate what you need versus what you want. And if you keep spending, if you don't have a clear idea of what how to balance your money, you will no amount of money would be enough for you. So that is basically no matter what, you need to live within your means. And there is a huge culture that where you are enticed by your neighbor, by your friend who's getting the latest iPhones, getting the latest cars and whatever. And most of it might not be based on the money that they paid from their bank account. Credit is huge in capitalistic countries, and you can just swipe your credit card and then you can buy. So people only see what you have bought. They see the Ferrari, they don't see the debt that is behind it. So that's the thing, there are obviously a lot of families who've gotten into debt, and um, uh, once you get into that cycle, it makes it difficult to get out of it. You might want to keep repaying debt from one loan to another, and capitalism allows you to do that. It allows you to revolve credit, revolve debt, and you only end up making the banker richer by paying interest. Uh, Whereas if you avoided debt and invested that money, you could make yourself richer. And to do all of this, a very difficult thing to practice is delayed gratification. Buying only when you have money, asking yourself a question about what can you really afford. Buying something just because your friend got it, your uncle got it, or somebody else, your neighbor got it, um, that's that's a trap, really, basically. So uh, delayed gratification, practicing that, you're not going to buy something unless you can really afford it. And answering that question of whether you can afford it is based on how much money you actually have in the bank and spending from it. Uh, and it's all related to peer pressure as well, right? So basically, we end up trying to live a lifestyle where we want to focus on what others think of us. Are they happy with are they going to look at us and think, okay, this guy's done something with his life, he's got a Ferrari, that's great. That kind of pressure can continue throughout your life, and it's very important to be mindful of that from the beginning. Okay, so here's probably the more interesting thing for most of you. Um, you need money to make money. The whole world of capital markets is all about um, getting high returns from your money, but you still need that money to make money. But the let's say you get into a job, even if it's a minimum wage job at McDonald's or whatever, if you're able to avoid debt, debt is all about spending tomorrow's money today. you're borrowing from your future. If you're able to save half of it and put it away, that means you are planning for tomorrow's expenses today. And if you're able to have a uh, I'm sorry, somebody has a little. Yeah. So essentially, this is the three basic things you need to do. And the thing is, first, if you end up spending more than your income, you end up incurring debt. If you end up spending first and then saving what is left, normally you won't have much left because uh, there are enough distractions of where you can end up spending your income. So the right way to do this is, if you get your income, save a significant percentage of it, 30%, 50%, whatever, and then spend only from what's left. This is a really good way to measure your affordability. Um, let's say whatever money you're getting, you might start off with minimum wage, you might get a job when you finish college, uh, but whatever be your first job, save 50% of it, spend only from what's left. Think that that is what you can afford, and that way you're paying yourself first before you're paying for other things. Okay, so uh, think we're coming to some interesting topics, some topics that people are interested in. So 2007, Steve Jobs introduces the first iPhone. I think it was about $500 or so, if I'm not wrong. If you had invested that $500 in Apple stock, it would be worth somewhere close to $20,000 by now. Um, well, you might ask, should we not buy an iPhone then? Of course you can buy it. It's all about balance. But the point here is, what is the value of the $500 iPhone that you bought in 2007? Not much today. It's just scrap value. But if you bought an Apple stock with it, it's grown in value. Why is that? Because the company has value. Uh, Apple as a company is making profits. They're growing. That has got value. Um, and it's just one example. There are different ways in which you can invest, but it's just one example of how investing can grow your money. And here's another interesting slide. So the whole thing about equity markets and buying stocks and um, investing in companies is that you need to give it a lot of time to grow, especially if you're having a portfolio of stocks that you are investing in. Here's an example where there are two people. One is Finn, investing about $5,000 every month for from the age of 21 till 31. So he invests about $600,000, and that's it. He just leaves it. Nancy starts late. She starts investing from the age of 31 till 65, same $5,000 per month every month, and she invests 2.1 million. But Finn's investments has grown to 30 million by the age of 65, even though he has stopped investing after the age of 31. He invests for 10 years and then that's it, he stops. And that money itself grows to a huge amount. So even if you start late and invest for a much longer time, you might still not be able to catch up. So the point here is, you guys really need to start thinking about investing from your first paycheck. And we are really glad to be able to talk to you today about these things because some of us learned the financial lessons pretty late in life, in our 30s and 40s. If you are able to learn these and implement these from your first paycheck, it's going to make a huge impact in your life. So 3 mistakes to avoid. So wanting to get rich faster, crypto, trading, Robinhood, all of there's just a lot of things available, a lot of distractions available that's going to promise you to get rich faster. Nothing exists. You can lose money faster. The way Luna lost its value, the way GameStop and AMC stocks, they lost its value. You are more likely to lose money faster than get rich faster. But getting rich slowly is possible, with a proper plan, with regular savings, regular investing, so not getting into debt. Very simple methods, get rich slowly, it is possible, but you need to have the discipline. And following latest fads, just following brokers and news websites and other places to Reddit or whatever to find the latest stocks to invest in. That's again not going to be long lasting. You have a plan of low risk, sensible investing. You probably invest in something like a index like the S&P 500, which is going to be the top 500 stocks in the market. Those kind of things are going to get you uh, to where you want to be, to better wealth, without having to take too much risks. And whatever promises you high returns will always have high risk. Anything that tells you you can double your money in 20 days, double your money in 6 months, all of that is going to have high risk. And risk is something you should learn to monitor when you start investing. And not losing your capital, that is going to be far more important than trying to expand your capital. There are much more a number of ways where you can end up losing money uh, uh, than being able to make high returns. So I don't know if Dhruv, you knew that you were going to make a guest appearance in the slide, but the point we're trying to make here is if you were allowed to trade places with Warren Buffett, would you do it? Which means you get all his money, but also you get his age.
I mean,
Dhruv?
this would be an interesting situation, but I think solely because of the time I would have left, I don't think that would be something that's as effective. But if I use the money I had now and use my time with me, I could hopefully get to that point.
Absolutely,
So,
absolutely.
can I share my opinion too, or
Sure.
okay? So, what my ideal situation would be is if I could. One second. What my my ideal situation would be if I had the knowledge of Warren Buffett that he has now at this age, but that's not possible, right? That's like you have that comes with age. So what I'm doing like by attending these meetings is hopefully increasing my like knowledge and getting there faster, maybe by like the year 30, like that. Because right now I'm currently only 15, but maybe
Yeah,
by 30 I'll be like that. But what like an ideal
absolutely.
situation, I want to be like him at like my age, but that's not like that's not like realistic, right? But to try to make it out from where I am right now, I'm like deep in the trenches, and to make it out, I wish I had that type of knowledge. But this is like really,
Absolutely.
I like where this is going though.
Yeah, yeah, absolutely. And the point here is that you can have that wisdom, and much of his wisdom is available publicly. You're 15 now, you start reading about it, you start figuring out what mistakes he did, what mistakes his mentor Ben Graham did. Charlie Munger and Warren Buffett quotes it. They've written a lot of books. There's so much wisdom out there that you can learn from. You can stand on top of their shoulders. The thing is, uh, becoming wealthy, becoming financially independent. The secrets are very simple. Whatever Warren Buffett and Charlie Munger are talking about, they're straightforward. The difficulty is in temperament. The difficulty is in behavior. uh, Being able to be patient when the markets are down, when your stock is down, when your investments are down, and not making mistakes. That is the difficult part. So uh, it's a fantastic thing that you're starting out at 15 and learning about these things. That's what I'm trying to talk about in the slide. You're all time billionaires today. You've got all the time to create value, make money, invest that money sensibly, and become wealthy. And you might end up becoming financially independent at 30, 35. It's possible. And it's great that you guys are starting right now. Some of us who start at 35, 40, we don't have much choice but to work until 60. Whereas you guys will have the choice to make sensible decisions right now. So great. Nice to hear that. So here's the thing. So does money buy happiness is a question that keeps coming. Money may or may not be able to buy happiness. Maybe it buys you temporary happiness when you buy things, but it can definitely buy you freedom. You get to a point where you have enough money so they don't have to work for somebody else, work for, you're not forced to work to pay the bills. Um, it can definitely buy you that freedom. This whole quote from that initial story that we started with. This is what life is all about. And if you're able to have a balance today with earning money, having this life, and then working towards that freedom with sensible investing, then you're off to a great start. So that's pretty much what I had. So here's the lessons again. Essentially, capitalism is a fantastic social innovation. It's got a lot more magic than traps. You need to be very careful with how to avoid the traps of wanting to spend, wanting to buy things, wanting to look richer, buying things on credit to look good. Just to buying things can just make you happy in the short term. But if you have a balance and if you're able to invest that money and give it time and be patient, then you're on to becoming wealthy, and it's possible. Um, all right, so that's what I had as a structured presentation. I'm available to take questions. Of course, sorry, I forgot this quote. If you don't find a way to make money while you sleep, you will have to work until you die. That's a Warren Buffett quote. So, and the way to do that is to invest in stocks, invest in companies, invest in um, even real estate, anything that can give you income, passive income. It can also be something for now as simple as a YouTube channel. That can also the thing with the YouTube channel is not exactly passive. You still have to keep making videos to be relevant. So it's sort of actively passive because you might end up making more money from your past videos, but the algorithms will not show you until you keep making regular videos, and those videos keep getting enough viewers. But um, uh, the more income streams that you're able to create, uh, the faster your path towards freedom will be. Okay, so let me start the presentation there. It was just a conversation starter. Any questions you guys have right now, will be more than happy to.
All right. So I wanted to start off by saying that Warren Buffett quote really hit home because you were talking about how like you can't make money while you if you can't make money while you sleep, which is like referring to passive income, you basically can work till you die, right? Because that makes sense. Because if you're not making while you sleep, you have to work when you're like living, and that really translates to me. But I want to like learn like more specifically how to get started investing in stocks because I don't really have like a figure like that I could ask, and every YouTube video is just like it's not it doesn't like refer to stocks like properly, and I'm not really understanding. So if you could go over that, that'd be very beneficial.
Sure. So you can so essentially what you're doing when you're buying a stock is you become a part owner in a company, right? When you buy one stock of Apple, one share of Apple, um, you have that part ownership in Apple as a company, and when Apple as a company grows, makes more profits, increases revenue, increases profits down the line, the value of your stock increases. So eventually, in the long term, that is how it looks like. But in the short term, there are a lot of things that can um, affect the price of a share. So you might have political situations, economic situations, interest rate changes. A different party comes into power. There are a lot of different reasons why people in the stock market speculate whether the stock is worth this much or whether it's worth less, and then it might affect the prices in the short term, but it doesn't matter. Investing in stocks in the capital market should always be about the long term. You should have a 10-year, 20-year, 30-year horizon. And when you have that much long horizons, then what matters is the company going to be profitable? Like Warren Buffett invested in Coca-Cola, and he knew that regardless of recessions, regardless of whatever, people are always going to be drinking Coke. When they have pizza, they'll have Coke. When they're out, they want to have Coke. He knew that that company is going to keep making profits, and he bought the stock. And over a long period of time, that company has given him a lot of profits because Coke has, as a company, has been increasing its revenue, increasing profits. So in the short term, the stock price might have gone up and down. But if you look at it over the last 20, 30, 40 years, the stock price growth would match to the rate at which their profits have grown. So that's what it's all about. But the difficulty is finding companies that are profitable. So Apple is doing great right now. Google is doing great. Will they continue to be uh, growing 20, 30 years, 40 years down the line when you actually need the money? Maybe yes, maybe no. You might have to keep tracking it. That's the difficulty that you have. A simpler way is to just buy the S&P 500 index. At this point, you will make more money by putting more money in than by the returns that you get from a single stock or whatever. So reduce the risk, just buy an S&P 500 index. That's more than enough for you to start with.
So if I were to buy like a Stranger Things stock, like a Netflix stock, not Stranger Things, right? Because that's what I'm understanding. They dropped the new season. The new season, I like it, and I think it's trending right now in the U.S. Right, like first, and a lot of people are watching it. Netflix is getting a lot of attention because of that. So if I were to invest in Netflix because of this new season drop, would I get a lot of money back due to like the popularity increased, or would this not affect like the stock
So,
because
so
the new season
you,
is just gas? Like you know what I
yeah,
mean?
yeah, you're thinking on the right lines. You know, a lot of people did speculate that when Stranger Things came out, it's actually going to increase Netflix value. But you know, the short term, that's not really how things work, right? They are facing competition from Disney. They're facing competition from all the other streaming services. So you really can't predict those things. You know, you should not be thinking in the short term at all. Is Netflix going to be around 20 years from now? That's the choice that's the thing that you'll have to figure out. Sorry, I'm going to ask and move on. I think Ian, you had your hand up.
No, that answered my question. Thank you.
What is exactly the S&P 500?
S&P 500 is an index, so it's a collection of the top 500 stocks in the exchange, ranked by market capitalization. Yeah, so see, S&P 500 is an index based on the stocks listed in the US, the top 500 stocks based on market cap. Uh, the exchange in China would have the top 500 over there. The exchange in Japan would have something else. In India, we have something called the Sensex, which is top 50 stocks in the Bombay Stock Exchange, and the Nifty 50, which is the top 50 in the National Stock Exchange. So that varies. The thing with S&P 500 is that given how expansive the American economy is, most of the S&P 500 companies have operations globally, and the profits come, at least like nearly 50% of profits come from global operations. So that's the advantage of having a S&P 500. But you know, if you want to diversify, you can definitely buy the index of the US, of China, of India, or you can buy something like an emerging market index. So that would include stocks from many emerging markets. You can definitely do that. But you need to know why you're diversifying. You know, are you diversifying for returns or diversifying for risk? Diversifying across geographies will reduce your risk for sure, but it cannot guarantee higher returns. And the other thing is, you know, when you're starting out with small sums of money, it's better to just keep it simple. You know, the more you complicate your portfolio, there is higher chance that, you know, you will get suboptimal returns. So to start with, S&P 500 is good enough for the amount of money that you're going to be putting in. Once your portfolio becomes bigger and substantial, and then you want to diversify to reduce that risk, sure, you can buy other stocks, other index. Again, investing should be boring, right? So if it's investing is an exciting thing for you, you are likely to make more mistakes. You're likely to chase fads. You're likely to want to jump from one thing to another.
But I thought,
You
but I
have
thought like, I thought making money was like supposed to be exciting because when you get like that return, it's supposed to be you're supposed to like be happy with the like the new money you get. But what's this what's it about to be
yeah.
boring?
So sure, absolutely. But that kind of thing, the challenge here is being able to do that consistently for the next 30, 40, 50 years or whatever. See, Warren Buffett has been around, he's been investing since the age of 11, and he's 91 now. That's 80 years of compounding. That's 80 years of not making mistakes. And so, I'm sorry, he's definitely made some mistakes, but 80 years of making less mistakes than, having uh, uh, bets that has really worked out. And if you look at his life and his mistakes and everything, you know, he still doesn't end up chasing short-term returns. You know, he buys something of value, and then stays patient for years, 5 years, 10 years, 15 years, how much ever long it takes to grow. And he's had that patience over 80 years. It is very exciting to see your money double in a few months. You know, you got this bet right, but your next bet could go wrong, and your next bet could drag your whatever profits you made the first time. It can drag you down below that as well, right? So it's definitely possible to make a lot of money in short term. You buy a stock, you just check Reddit, what's the latest thing. You buy something and grows. significantly, or you know 6 months, all that extra money, free money is fun. What do you do with it afterwards? You either continue, and then the stock might fall from the peak, or you might sell the stock, and then once you sell the stock, what do you do with the money? Again, you will have to find another company, another bet, and that one has to work out. Maybe it will, maybe it won't. So that's the challenge here, basically.
So what I'm understanding is if you when you do get returns right in the stock market, you'd want to take 50% of it, let's just say like to be really safe, and put it somewhere in like savings, and then out of that 50% you drop more into the market, and you save like, and then you exponentially grow your savings, and then like with the little money, yeah.
Right, right, absolutely. So that's a good point. So the way we would recommend doing that is having an asset allocation, right? So keep 70% of your money in equity, have 30% in debt. I think in the US you have inflation adjusted bonds, so that's going to give you at least inflation level returns. So at least your money doesn't lose value, and you have your 70-30 asset allocation, right? And then your equity is going to keep going up or down. That's the way it has always been. That's the way it always will be. Um, Long-term growth will be determined based on GDP growth and corporate profitability. But short-term, there could be a lot of speculation which could be driving things up and down. So your asset allocation is going to be your compass. Your 70% equity, where it goes up crazily, it will end up becoming 90-30. And then you sell some equity and then put it into debt, so you rebalance back to 70-30. And then when there are going to be times like 2020 March, when the COVID pandemic first hit, the markets fell down, your 70 is going to come down to 50 or 40. Then you take some debt and then put it into equity. So that way you're buying low and then you're selling high. Okay, you keep doing this, keep this asset allocation, and that's going to help you make profits regardless of whether the market is going up and down. And it's going to be impossible to time the market. A lot of people have tried. It's going to be very difficult unless you there are you really need to probably have some method like 6-month moving average, 12-month moving average. There are ways to time the market, but most people don't end up doing that. They just read the macro signs and then they think they can time the market. There are a lot more money lost by people trying to time the market than by just investing in this, staying invested. So this asset allocation is going to be a compass that can help you when to sell, and it'll help you buy low and sell high. That's one thing. And the other part of asset allocation is have at least make a plan, make a idea of how much money you want in life. You want to become a millionaire by 30 or whatever. Invest that in low risk index funds, or a set of stocks, blue chip stocks or whatever. The rest of the money, that anything above that you're able to save, do whatever with it. Scratch your itch, buy crypto, buy small stocks. You do that for fun. That is your wealth maximization bucket. If you lose that money, that's fine. The rest of the money is still growing. So have those as two separate goals, and work on them separately. That would be our advice.
Awesome. I had a few questions for you guys speakers, and we can make this sort of like an interview session. So, my first question would be like, what do you think is the safest investment this year and the riskiest investment this year?
Okay. So actually, it's a really good question. We don't like this question the way, I'm glad that you asked, because every year things would keep changing. There would always be a new fad, something exciting, something new. You should not, the whole point of this presentation has been to not chase fads like that. So it's not about which is good this year, which is bad this year. Um, you should always be thinking about long term when you're thinking about investing. So when you're talking about an S&P 500, you just buy that index, and then that's it. You have an asset allocation. Just forget about it. Buy it, keep investing, keep earning money, keep investing, and forget about it. Right? You don't have to worry about, maybe once a year you can do a rebalancing between S&P 500 and your inflation bonds, and that's it. Or if you're buying stocks, then again, just keep monitoring. Unless the company has done badly fundamentally, there is no need to sell the stocks. There's no need to keep chasing what's best, what's new, because that will keep changing every year.
What would you say is one thing we should look out for as an investor going into this field?
um, Patience. Really need to have a lot of patience. You should uh, think long term, start early. invest and be patient and focus on other parts of your life. Don't focus on investing as your full-time hobby or whatever.
Okay. Another thing is, what is one thing that you have learned along your journey in the finance field?
Um, that getting wealthy is simple but not easy, because we keep giving the same advice to a lot of people. Few people are able to actually implement it. Most people are not. Um, Basically, they end up falling in the trap of capitalism, and most people end up doing the same mistakes that everybody is doing, and it's very difficult to get out of it.
That's why only some people are rich, because if it was easy, then everyone would be rich.
Exactly,
That's great.
exactly.
And what would be your one piece of advice for all young investors looking to get into this field? And one thing that they should make sure that they're always keeping in mind and that's at the top of their head.
Um, yeah, focus on risk more than returns. It's always easy to focus on returns, but be mindful of the risk.
And there was a question in chat for you. What is your favorite part of investing?
uh, that every day I'm working closer towards financial freedom.
Thank you so
Glad to
much
be
once
here.
again for going through that meeting. And this event will be recorded and posted on both our YouTube channel and FLC website. So if you weren't able to attend or you would like to share this event with other people who couldn't, that will be available there. So you can go ahead and see it there. Thank you everyone for giving your time.
Thank you. Bye bye.